And welcome to part 2 of our video lecture on corporate distributions. When we left off, we were talking about calculating E&P. So I believe we had already spoken about these 4 items, and we were right here. So what sort of additions are there in detail? Like we saw on the previous screen, tax-exempt interest, life insurance proceeds less the cash surrender value to the extent there is one, the entire gain on the installment sale that occurs in the year of the sale, and then of course that would mean that in future years, as you recognize that installment gain, you would deduct that to get to E&P in future years. And federal income tax refunds to the extent that they were previously deducted from E&P, which is likely. So deduction add backs, the DRD, which we talked about, the DPAD in prior years, no longer for 2018 and beyond. Accelerated depreciation, because E&P uses straight line. You'd have to add back, therefore, bonus depreciation and any immediate expensing under Section 179. For this purpose, you add back 80% in the year you take the 179, and then 20% deducted per year for 5 years. So the organizational costs of amortization, those are not permitted for E&P. Deductions that are allowed, the non-deductible portion of meals and entertainment. Non-deductible expenses related to tax-exempt income, federal income taxes paid, fines, related party losses. I'm not going to read this list to you. You guys can read it to yourselves. These are all things that you would have to add back in the year in which they occur. Timing components. So we know about percent complete, not completed contract. So that means that you can't wait to recognize the income till the end. E&P allows cost depletion, not percentage depletion. That's just a nuanced form of cost recovery for natural resources. And of course, FIFO, not LIFO. Okay, so Juno Corp has the following during the current year. And what I'd like you guys to do, even though I know none of you will, is read this example, go through it on your own, pause, see if you can calculate taxable income first, and then earnings and profits. And I'll give you a hint, this is the kind of in-class exercise we're going to do. So it would make sense for you to do this on your own. But if you don't, you don't, right? I can tell you that the next slide has the answer on it. But you ought to try it on your own, because otherwise, honestly, you're just going to hear me talk through it, and that's not going to be that interesting. So take a pause, do it now, then work on it. See you in a few minutes. So presumably you did it. Otherwise, welcome back. So first, let's calculate taxable income. We take the sales plus the dividend we received plus the long-term capital gain. That's all gross income. Then we would deduct out the salaries, the DRD at 70%, because presumably these are old rules. Wow, I should have updated this slide, because today would be at 65%. Sorry, 70 would be at 50%. Then depreciation and the long-term capital loss, which would ordinarily have been limited. So we get to deductions of 19.5, or is limited, I should say. So we get to deductions of 19.5. That gives us taxable income of 84.50. Now we need to reconcile 84.50 to E&P. So we add back, or add in tax-exempt interest. We add back the DRD that we took. So in this case, even though it's the wrong percentage, it doesn't matter. We then add back the accelerated part of the depreciation so that we get to that increase. And then we say, okay, what things do we get to deduct this year that we simply didn't get to deduct for taxable income calculation? That's the excess long-term capital loss, right? So that a capital loss that was in excess of the long-term capital gain. And of course, the federal taxes we paid. And therefore, we get earnings and profits of $13,450. Okay. So a cash distribution to the shareholder is a dividend. But the dividend amount is limited to the distributing corporation's E&P amount. That's what it says under 301. So the result to the corporation is that you reduce E&P by the distribution amount, limited, of course, to the amount of E&P. And as I spoke about on the very first slide, I believe, you cannot create negative E&P through a dividend, through a distribution. Current E&P is allocated proportionately to all current year distributions. Now, I'm not really going to make you jump through the hoops of multiple distributions during a year when E&P doesn't cover all of it. But the notion is you do have to deal some way with deciding how much E&P gets allocated to each distribution, and it's not a first in, first out. So don't think of it like the first distribution of the year would soak up all the E&P. Then if there was another distribution later in the year, oh, that's all tax-free. No, it's allocated. So accumulated E&P is allocated chronologically to distributions during the year, which is kind of like just the opposite of current E&P. So I'm going to try to do something tricky here while I'm recording this video. You probably heard the ping of my phone. My wife is telling me I have to go pick up my son from soccer. So the good news is, this video is going to end in about 15 minutes. So I need to say yes and send it on. Okay. So like I was saying, accumulated E&P is chronologically distributed. Current E&P is allocated proportionally across. A current loss is allocated pro rata against the accumulated E&P available on the date of the distribution, unless the date of the loss is specifically earmarked. So you have, excuse me one second, you have this unique opportunity to, when you have a giant loss that can be specifically identified to a certain transaction, to try to earmark that loss into a certain period. And we'll talk about this allocation of the current loss here shortly, because it becomes part of the way that you calculate the dividend amount anyway. Okay, so let's run through cash distributions and the four possibilities. Okay, so the four possibilities are you have positive current and positive accumulated E&P. And the rule is it comes out of current first, then out of accumulated. The next scenario is you have negative current E&P and negative accumulated E&P. Well, if they're both negative, you can't possibly have a dividend, so that's easy. It's going to go out of basis and then become a gain. If you have positive current and negative accumulated, then it goes out of current first, whether you have negative accumulated or not. And then if you have negative current and positive accumulated, then you measure total E&P on the distribution date. To the extent that's a positive number, then it is a dividend to the extent of total E&P on that date. So the only way to roll through this is through what I would consider to be a ton of examples. So let's get started. So under all of these, we're going to have a corporation make a distribution of $15,000 on July 1st. Now, technically, when you prorate E&P for distributions, and I'm only saying this because I've oversimplified these examples, you actually have to count the number of days. And technically, July 1st is not 182.5 days, but because it makes the math so much easier on everyone for these examples, we're just going to treat it like it is exactly halfway through the year, in spite of the fact that it is not exactly halfway through the year. Okay, so in scenario A, I have accumulated E&P of $40,000, and I have negative E&P for the first half of the year, $50,000, and I have positive E&P for the second half of the year of $55,000. So at the end of the day, which is when I need to measure this, I have positive accumulated E&P for the year, and I actually have positive current E&P for the year. Well, if we go back to the chart we had on the last page, we say, look, it's a dividend to the extent of current E&P first, and then accumulated E&P. So my total current E&P is $5,000 at year end. Therefore, it comes out of current E&P first, so that $5,000 gets soaked up. And then $10,000 more of that distribution comes out of accumulated E&P. So what that would mean is we would finish the year with no current E&P and $30,000 of accumulated E&P. Under scenario B, I have negative accumulated E&P of 60,000. I have positive current E&P for the first half of the year and negative current E&P for the second half of the year. So at the end of the day, I have negative accumulated E&P and positive current E&P. So this is a situation where this is the nimble dividend rule. It says, look, first it comes out of current E&P. So because I have positive current E&P of 5,000, I have a $5,000 dividend. The rest of it, there's no more E&P left, and so it's got to be return of capital or a gain. So in our next scenario, we have accumulated E&P that's positive of 40,000, and we have negative E&P for the first half of the year, 50, positive E&P for the second half of the year of 45. So collectively, my total current E&P is negative. When I have positive accumulated E&P and negative current E&P, it's a dividend to the extent of total E&P on the distribution date. The only way I can determine what total E&P is by a pro rata allocation. Again, only if I have a specifically identifiable loss can I try to earmark a piece of that loss for a current period E&P. We're assuming that's not the case here. So that means my total E&P on the date of the distribution is accumulated E&P of 40,000 minus half of my E&P loss for the year of 5,000, which is 2,500. So that means I've got 37.5 of total E&P on the date of the distribution. That's clearly in excess of the amount of the distribution of 15,000. Therefore, this is all a dividend. In the next scenario, I've got accumulated E&P of 40,000. And in this case, I have a loss of 50,000 for the first half of the year and a loss of 5,000 for the second half of the year in E&P. So again, I have positive accumulated E&P and negative current E&P, which means I need to determine what is total E&P on the distribution date. Well, my current E&P at year end is 55,000. As a result, half of that prorated back, I believe, is 27.5. The 40,000 minus the 27.5 leaves me positive total E&P on the date of the distribution of 12.5. Therefore, it's a dividend to the extent of 12.5. The rest of it, return to basis and then capital. In our final scenario, I have negative accumulated E&P, and over the total of the year, I have negative current E&P. Therefore, I have no dividend. Okay, so we've talked about this a little bit, but now let's be a bit more discreet about it. So in a situation where I have distributions that exceed E&P, how do I deal with it? So I've got accumulated E&P of 0. I've got current E&P of 5,000. I've got a corporate distribution of 17.5, and the stockholder receiving the distribution has a basis of 10,000. So what is the result, and then what is the corporation's E&P afterward? Okay, so let's see. I've got 0 accumulated E&P, but I've got current E&P of 5,000. So this is a classic nimble dividend, which means that it comes out of current E&P first. So 5,000 is treated as a dividend. The rest is but I still have 12.5 distribution I have to characterize. The next 10 is a return of capital. So I zero out that stockholder's basis, but I still have 2,500 left, and that's treated as a capital gain, assuming that the shareholder is owning that stock as a capital asset. If they're holding it as an ordinary asset, which is plausible under a dealer and securities kind of scenario, they might not treat it as a capital gain. But in this case, it is a capital gain. E&P is reduced to 0, right? So we can never make negative E&P. So the corporation's E&P goes to 0, and that's just where it sticks. All right, let's do another scenario. In this case, accumulated E&P is negative 15,000. Current E&P is a positive 10,000. The distribution is 10,000, and the shareholder stock base is 10,000. So again, what is the result, and then what is the resulting E&P afterward? Okay, so when I have negative accumulated, positive current, same thing. It comes out of current first. The entire distribution is a dividend. There's no more distribution left. So as a result, we're just done. It's a $10,000 dividend. The corporation continues to have a $15,000 deficit in E&P. So there are no adjustments to the accumulated E&P account. We just zero out current E&P. Okay, a little bit more on dividends. No, we've been going about 17 minutes. I'll see you in part 3.